Hello and welcome to Money Control. The Nifty is back at an all-time high. There is more than one reason for the market to cheer today. First is the better than expected GDP number announced yesterday. The GDP number came in at 7.6% compared to the consensus estimate of 6.5%. The strong growth was driven by investments, especially public investments, but net exports and private consumption continued to drag. The second reason for cheer in markets today is the exit poll results, which show a more than favorable outcome for the BJP compared to what the market was expecting. So what does the Money Control poll of exit polls tell us? It shows us a possibility of a 2:2 draw between Congress and BJP in the key Hindi heartland states and Telangana. I'm not getting into the details of that. You can go to moneycontrol.com and access those results. But what is indeed coming out very clearly is that brand Modi is going strong and delivering even in state elections. We need to remember here that the BJP had lost all these 4 key state assembly elections in December 2018. Yet, just a few months later, in 2019 national elections, the BJP swept Rajasthan, Madhya Pradesh, Chhattisgarh and made inroads into Telangana. Voters often do not vote the same way as they vote in states at the center. But the fact that 5 years later, BJP has managed to get ahead now in 2 assembly elections obviously indicates that it remains in pole position in the road to 2024. That's the backdrop. Let us go over to our guest this afternoon to understand more about these results, the 2 big news that has come in between yesterday and today. We have Jigar Mistry from Buoyant Capital and Madhavi Arora from Emkay joining us. Madhavi, your take, are you positively surprised from what you were expecting from the exit poll results, and how do you read into all of this?
No, so clearly, I mean, exit poll again, as you rightly said, is not the best barometer. But I am not too surprised with regard to the results on Rajasthan. I mean, it still looks to be a very tight case. But on net, if you take polls of poll, it's still showing, BJP advantage in the state of Rajasthan. And MP, again, was supposed to be a close fight. But whatever we can read out of the exit poll vote share of certain agencies which have done that, seems to show that the margin of vote shares actually increased for the BJP, despite the fact that there was fears of anti-incumbency that the state was probably facing. So I think on net, not too surprised with the outcome of exit polls, but again, we need to take them with a pinch of salt because as you said that they're not neither definitive and nor are the state results a perfect proxy for national results. So, but I think incrementally it looks to be a very positive case for the markets, if at all the exit polls, are indeed correct this time around. But we need to know that, last time, the same period when the exit polls happened for this, these 5 states, there was an accuracy issue as well. So, to that extent, I think we need to keep
Sorry,
some
I've
margin
lost
of.
your audio.
Yeah, I was saying that if I look at the 2018 elections
Madhavi, I
for
can't
these.
hear you.
Hello, can you hear me? I can hear you well.
So, we'll just go into, we'll cut into Jigar Mistry, who is also joining us. Jigar, what is your take? Are you surprised by the exit poll numbers? Is it radically different from what the market was expecting? And how do you see this panning out on Monday?
Good afternoon, Lakshmi. See, I think the way in which market reads this is whether the policy perspective continues going forward, or you essentially start developing something else. With the kind of numbers that have been released yesterday, I don't think the market seems to be worried beyond a point as to whether there is going to be a change in policy action or not. So clearly, from the domestic standpoint, it looks as if things are likely to continue. Now, if we break down the flows in terms of how different set of investors view this, I think there are the foreign institutional investors. I do not think, from my historical experiences being a sell side analyst, I do not think they look at state elections in that greater detail. And therefore, it might be, sort of reading too much into it as far as they are concerned. They are regardless not going to take a very large call until the sort of final general election gets done. That essentially means that the market, then the ball is then passed on to domestic investors, and the kind of rally that we are seeing in the small and mid cap space is the testament to what's really transpiring. Just to share some data, since the end of March to end of October, we have seen some 150 companies whose share price have more than doubled. Even in the BSE 500 index, the smaller cap companies have outperformed larger caps. And you are seeing a scenario where the lower the free float, higher the returns, lower the market cap, even within the small cap segment. So less than 4,000 crore market cap, higher the returns. And in fact, I had written this article last week for Moneycontrol, where we highlighted in detail on how the entire rally has transpired. So I think the way in which domestic investors are reading this is, continuity of the same. You don't really change anything. In 2018, after having lost, the state elections in a big way, BJP came back with a bang in 2019, and I think that was the common extrapolation. If the situation appears to have improved on the ground from what the exit poll data suggests, then I think there is a lot more cheer in the market on that account.
Sure. Madhavi, I'll just, if you can just complete the point that we got cut off. So you were talking
No,
about,
I was just simply saying,
difference
can you
between
get
the
me?
exit poll and the reality often is, it can be erroneous. So we can't conclude anything from what we are seeing today. Is that what you're saying?
Correct. Yes. Can you hear me well now?
Yes.
Okay. So I was basically making a point that, you have to take the exit polls with a pinch of salt. Of course, they're still a better barometer of results than, say, opinion polls, and they are generally, able to direct a trend, at least, even though they may not be quite accurate in terms of seats. If you go back and see the 2018 election for these same states, which actually depicts that only half of the polling agencies were able to accurately predict the winner based on the exit polling, and even less than that got the seats tally right. So there was a good margin of 10 to 15 seats here and there. So generally the trend has been still directed well by exit polls, but there's still an accuracy issue that one has to keep in mind.
Fair enough. Jigar, coming back to you, you were talking about stocks. We will come to that in a bit. But, what is your reaction to this, huge outperformance in terms of GDP numbers announced yesterday? Because somehow consistently the market seems to be lagging the numbers that we end up attaining quarter after quarter. What's your take?
Right, Mahalakshmi. So I think sort of the way in which things are adding up, not just from the current standpoint, but as a sort of, again, not an expert on either the sort of fiscal or the monetary policy, we have a better guess to address that. But I think the way in which we are taking this as sort of institutional investors is how you see this developing over the course of the next few years, and whether the data that is thrown is in consistency with that long term objective or not. Now, over the course of the next 2 decades or so, the working age population in India will grow from something like 83 crores to 100 crore plus A. And B, sort of up until now, although on a total GDP basis, India is in the top five, but on per capita we are number 127. And historically, with a per capita GDP in the below $3,000 range, you hardly see an economy developing 62% from services. So both those data points suggest that not enough has been done with the manufacturing side. Whatever advantages we had in the early 80s were fretted away. And with the new PLI schemes, I think a large part of that is planned to be recouped. Now, if I put the two things together, higher sort of labor force participation and resultant productivity gains, the fundamental fabric of India tends to show a rather decent improvement over the longer term. Now, we don't sort of nitpick whether it's 6.8 or 7.2 or those sort of numbers really matter in between lines. But if the direction is indeed showing a result where, your GDP is in an upward trajectory, then beyond the 3.5-4 trillion, you hardly, if ever, have any market. Like you can look at Brazil at about $2 trillion. That's sort of all commodities. Saudi is at $1 trillion. That's all oil. And therefore, foreign institutional investors looking to park incremental capital as the interest rates globally would look to come down after 3 or 4 quarters will have very few markets to look into. So, if those two things are happening, then eventually, possibly post the general elections, foreign institutional investments in India would look to pick up, and domestic investments is hardly at all leaving any signs for disappointment. So you put those two things together, fundamentals looking decent, flows looking incrementally positive, equities does emerge as among the better asset classes to going into the data.
Sure, fair enough. Madhavi, the medium-term, long-term picture definitely is well chronicled. Tell me about the next 2 quarters, because ahead of elections, and if we see, second quarter GDP numbers also, the strong momentum really comes because of, public spending. Going into the next 2 quarters before the general elections, how do you see this momentum continuing? What kind of impact will it have? Will we have to see some spur in consumption for this momentum to then get carried forward?
So, this time around, the government has done, both center and state, is that they have, to some extent, if not much, have sort of front loaded their spending pattern.
Right.
States tend to spend much more in the second half of the years, while center has over the last few years in the NDA government have generally been more balanced in their spending. But this time, both of them have sort of front loaded their growth, their spending pattern, which basically means that the second half will likely be a relatively slower story on public spending on the revenue expenditure versus the first half. So that was a big buffer in terms of the fiscal impulse that the economy enjoyed. Part of it will fade, of course. On net, the fiscal support is still pretty much there, but incrementally, it could probably be fading as you get into the second half of the year. But of course, it will also, have some multiplier effect in terms of, private consumption, which will be seen with a lag. If may not be in the coming 2 quarters, but maybe, beyond March. Ceteris paribus, that should be positive for consumption story in general. But I think in the immediate run, given the fact that policymakers have sort of front-loaded their spending ahead of the election year, I think second half could be a relatively tepid government spending story.
Okay, interpret this for the stock markets, Jigar. In the next 2 quarters, if you see, and also looking at the past quarter results, I mean, how the industrials performed versus the consumption stocks performed. What do you see? What is the picture that emerges for the next 2 quarters? Where do you see relative value?
Value is sort of a misnomer these days, Mahalakshmi. So it's I think you see relative value very difficult to find. The three sectors that have been the best performers have been capital goods, automobiles.
Let me rephrase that as relative growth than relative value.
Is there exactly that's where the dichotomy coming from, right? So we did talk in the past about how a good company and a great investment for us at least have been two different things. So you could get into a scenario where your growth continues to happen, the market is too early to sort of project that, and the share prices move way up ahead in anticipation of earnings growth, and then at a certain juncture the earnings growth catches up. Now, at the stock level, we find this on several occasions. Now that's sort of transpiring even at the sector level. Let me remind sort of you and some of the investors here as well that in the 2008 capital goods rally that we see, it was in fact since 2002 the best performing sector. The whole index was up 23 times, if memory serves. Siemens was up 45 times, ABB was up even higher. And after that index peaked with the global financial crisis, we did not see the same level on the index until 2021. Correct. So, sort of these sort of cycles are getting elongated. My sense is that a large, incremental investment is coming from investors who have not really seen a huge drawdown. So, people who started post COVID and they think, markets only go up, have so far been proven right. 2022, India did not see a deceleration in line with, say, Nasdaq or Dow Jones. But I think they are sort of, at least in our opinion, extending this beyond what is warranted in the sort of earnings growth. So any reverse DCF of companies would suggest that investors are pricing in slightly too much. And then there is some amount of delivery that needs to happen before we realize that these valuation numbers are sustainable. So my sense is, yeah, utilities again. See, in the interim, it makes a lot of sense. But you look at the power structures in India, as in by the utilities structures in India, the only sub-segment, I can break it down into sort of coal mining, generation, transmission, and distribution. And the only place that makes money is coal mining. Transmission is a fixed ROE, generation, some part of it makes money, a large part of it does not. And distribution loses like 90,000 crores a year. Now, given the federal split in India, the central government is responsible for putting up the wires. The responsibility of the state is to make sure power flows through that wire. And there you don't really see both of them seeing eye to eye. And most state governments are now using power as a vehicle to, equalize the sort of Gini coefficient. So it's not a commodity to be fairly priced. It's a commodity to, you be used as a socialist measure. Now, in that scenario, the sector will unlikely become, sustainable in and of itself, and that creates an issue with regard to how much you can value these businesses. But that again, in the longer term, shorter term, the party is on, so why really, prevent it?
So if you were to take a call on power, I think I will be digressing, but still, since you have talked about power, if you were to take a call on power, what should you look at? I mean, you have to look at it as you said, a fixed ROE business, and therefore, today if you look at book values, anything over one time, you need to assume that your interest rates will have to be much lower for you to be buying them, even if you were to front end growth.
That also argument holds to a certain level, Mahalakshmi, because then if the ROE keeps going down, the CERC will come and bring down your ROE estimates as well. So what terminal value you give to these businesses? But in between, there will be, okay, so general elections, state elections, a lot of, a small time equipment manufacturing happens and they want to install smart meters. I have been a utilities analyst. I was very positive in 2012 when APDRP was installed. Then sort of again in 2015 when Uday 1 was there. 2019 I was a little skeptical when Uday 2 happened. And this time around sort of, I'm just hoping that better senses prevail. But okay, so because your discoms can't really tie into long-term PPAs, your power exchange volumes go up, and their companies who have not fully tied up power, they become an alternative to sort of play over the shorter term cycles and so on. Finance companies, whether do they actually deserve a valuation which is multiple time price to book, given the sector is not truly balanced, is a question. They have done phenomenally well over the last year, but I think there is a limit to which the valuations will dictate those gains going forward. So utilities, again, fixed ROE business is a lot better. But I still think they are all better played vis-a-vis banks rather than your utilities themselves.
Okay, fair enough. So Madhavi, coming back to elections and GDP and the macro bit, usually the markets tend to worry a little bit about the election year because governments tend to over splurge. Spendings are a little bit on the higher side, and that could cause fiscal slippages. Now that we have growth in place, and the fact that if these exit results are the pointer to what is going to be the reality on Sunday, we don't need to really worry about that. Would you agree? Because you have some headroom in terms of, if there is growth, then obviously your revenue traction is also better.
Sure. No, so see, one thing is very certain about the current government is that for them, fiscal prudence, has been a non-negotiable issue. Markets on and off have been, sort of fearing that the government may deviate from a fiscal discipline. Every budget is analyzed with a sort of a negative eye as far as the economists are concerned, that there could be slippage here and there. While we can debate about the quality of fiscal management in general over the last two, regime of the NDA government. But one thing is very clear, unless of course it's a external shock. To a large extent, they generally do not deviate from their fiscal discipline. Even if they're spending in one segment of the economy, which is relatively higher, the other segment tends to get cut. So even though they could be probably pushing the agenda more towards rural and agri development spending, other segments of the economy would be feeling the pinch in terms of the expenditure allocation. So I don't think that is a issue to really worry about. This government hasn't been, at least on the central side, I wouldn't claim what's the state level, but on the central level, and hasn't been very fond of any kind of social sector spending schemes which are over the top as such. And generally the Modi government has resisted the idea of freebies. So I don't think that's a big worry. In fact, to a large extent, this government has been sort of credited as a government which has generally followed fiscal prudence and discipline in a more long term trend. So I think that would not be a issue to really discuss, as far as my understanding goes.
Fair enough. And your thoughts on, consumption going forward in the next 2 quarters? Do you think private consumption could surprise positively?
So it has been relatively patchy. There's not been a very strong cyclical trend. Every quarter, we tend to talk about the rural consumption, either having done better or, probably has disappointed. I think if I take a more smoothened view on the rural consumption, there hasn't been much kicker as such. The rural wages, even though have improved in the real basis over the last, 1.5 quarters, still, is relatively not really in a comfortable zone. In fact, it's still mildly negative, if I recall correctly. Plus, if you look at the Manrega labor demand, demand for work has actually increased, showing there's some kind of a distress in terms of the labor market there, which is probably not exposed very well in either CMI or the NSSO data that comes from the government of India. At the same time, urban consumption is relatively resilient, but I think there's also now a K-shaped behavior which is coming out in the urban sector, where the mid-income categories in urban sector is looking to relatively be slower in terms of the growth in the consumption pattern versus the premium category or the rich category, which generally has seen more resilience. I think to some extent, the last 2.5 years of comfortable urban consumption was also led by the fact that the income growth of sectors like IT, BFSI have actually been pretty robust, which is likely normalizing in 2023, and which will also imply that some part of the income effect will be felt by the upper middle class category in the urban sector. So I think not too gung-ho about the urban consumption to a large extent. Part of the private consumption in early part of the year was also led by a lot of leverage that consumers had taken, because of which RBI also had tightened the lending norms for banks to some extent, which will also weigh as we get into the next couple of quarters, because banks to some extent would also tighten their screw on personal loans. So I think there could be some stress in that, but nothing too dramatic. I think on an average, we're still okay on consumption. It's not a great driver for growth as such for this year, but it's not been too disappointing either.
Sure. So, Jigar, again from the market perspective, how does this consumption pack look? Because there has been a lot of optimism around discretionaries making a comeback. Auto has been one of the sectors that has done really well. Real estate is another pack which has done exceptionally well over the last 1 year. I mean, whatever time period you look at in the past 1 year. What your thoughts on those two segments of the market?
Right, so slightly tricky. So, see, automobiles, if you see, the problem is emanating from the fact that EV is becoming a reality. Now, most of these companies draw hardly, if at all, any revenues from the EV space, but the valuations have an embedded valuation because of the investments that they have received. The problem is that most PE firms also are not really aware as to what technology will eventually, take over. Whereas EV is going to be a reality, the vehicle that will drive us to that transition is not very, very clear. In which case, they have also chosen to, for the lack of a better word, spray and pray. They have given like $1 billion to 10 companies, and they realize that okay, one of them will go up to $100 billion and nine will become zero, and therefore that's a 10x in 10 years sort of a return. The problem with that is that we don't know which one will go 10x, and as public market investors, we can't invest in 10 automobile businesses, and therefore, whichever time the deflationary impact starts happening because one technology takes the lead, that's when, even if your earnings at the core business is growing, the share prices will leave you rather disappointed. So that is a scenario where I don't think there is a lot of room left. The way as a fund we have chosen to place to auto ancillaries, they are a lot more resilient. They'll still keep on getting reasonable amount of orders, and from an embedded valuation standpoint, you don't tend to lose out a lot. On the second sector, Mahalakshmi, on real estate, again, kind of tricky because balance sheets are very difficult to understand. And if I look at the only sector post 2008 which has not gone back to that level is real estate. In fact, it's a fraction of that valuation today. So the underlying belief is that you can either be very positive on the markets, believing that household savings will incrementally come onto the markets, which is the fair call. Pre-90s, we were at almost 20%. That fell to 3-4%, now possibly up to 5-6%. That needs to go up, in which case, if the economy is getting organized, the real estate business will not really see that much of a value appreciation as much as volume growth. And in which case, if you understand balance sheets, it's easier for you. For investors like us, that's sort of quite tricky. So again, the proxy play is cement. Given what's all around that's happening, that business continues to remain fairly good and provides a reasonably decent proxy with clean balance sheets to not just real estate but also infrastructure.
Sure. Madhavi, if you just look at time from now to general elections over the next 2 quarters, can you call out some headwinds that we may see? Crude, for example, where do you expect that to be? Any other global risks that you see that can sort of cause damage to markets? And are there any tailwinds that you would assign high probability to?
No, I think some cyclical headwinds that you can probably see, would be even assuming that Brent remains at this level, or commodity prices are steady versus the current level. The so-called terms of trade benefit of lower commodity prices on year-on-year basis, which was basically boosting the company's margin and leading to very high profits, would sort of fade. That is, I think, one of the big headwind that I can think of, because clearly that will impact companies' margins, their profits, and this is what gets into your growth projections, on a value-added basis. So clearly, it will lead to a much lower manufacturing growth in the second half of the year. Of course, agriculture is something which will be non-performer this year. I think it probably will grow sub 1%, probably 0.8, 0.9%. I think globally, so we're not worried too much on the crude front. I think it's going to be a very rangy story. I don't think it is going to sustain 95 plus level. Even if it reaches that level, I think it's fair to assume that for the next 1 year or so, again, Brent would be a very rangy game of 75 to a 90 to 95 at best, and somewhere averaging close to 85-ish kind of level, which I think as an economy we are able to comfortably bear at this point in time. I think global headwinds, if at all they can emerge, would be a relatively worse global growth scenario, which also will mean that there could be if at all there's a case of a hard landing in the US, which is visible in the next 3 to 6 months. I don't think that is the case at this point in time. Not that we are probably seeing a soft landing either, but definitely a hard landing scenario is relatively less probability case. But if at all that happens, it will have a spillover via asset classes across emerging markets, and India would not be spared. And of course, the second order impact in terms of the trade dynamics and stuff like that. So that will be felt, but I think in the immediate run there'll be some normalization of the first half tailwinds is what probably will play out than any big shock, positive or negative as such.
Fair enough. Jigar, one last question. If you were to see technicals, under-owned stocks, over-owned segments, etc. Monday onwards, if the market were to, gain momentum based on, the results of the polls and the general momentum that we have seen over the last few sessions, where would buying come from? And if we were to see this fizzle out, where would the selling go?
Very tricky question, Mahalakshmi. But I think, see, the place in which we can expect a reasonably decent play is the large caps. With the small caps having moved the way they have, it doesn't leave a lot of room on the upside. But large caps, especially banks, people have been very worried that because of the FI over ownership, they have not really seen a reasonably decent performance. Although historically speaking, banks are not trading at valuations which are more expensive than their past. But if you look at the top 10 overowned stocks by FIs in India, six of them are banks. And therefore, the fear is that if FIs keep selling, then you will likely see a scenario where your banks will continue to underperform. Given valuations elsewhere have gone up through the roof, I think that feeling might be pushed aside and people might actually start looking at banks a lot more favorably. And clearly, that's the trade that we think makes the most sense. Selling, difficult to say. See, I think the bigger issue that we are grappling with is that we don't think investors fully appreciate that higher interest rates in the US is not the same thing as higher for longer. Right? The monetary transmission in terms of mortgage rates have not really happened. Secondly, cash balances for households and companies have fallen to multi-year lows. So if things were to incrementally go worse, then you will likely see a scenario where there will be a total deflation, and that's a sort of up until a certain point, small and mid caps, because individual investors sort of control the free float, won't fall as much. But as you saw with, say, a Russia Ukraine kind of situation, the index fell 60%, small caps were down 22%, many companies were down 30 to 35%. So, up until a certain point, I think small and mid cap continue to hold the game. But if the sort of sell off is quite intense, then I think small and mid caps have a huge downside vis a vis the larger cap businesses.
Fair enough. With that, it's a wrap. Thank you so much, Jigar and Madhavi. It was a really nice discussion. Thank you so much. Have a great evening.
Thank you for that. Bye.